Hello and welcome to the Mutual Fund Show. My name is Nilesh. Shah. Over the next 30 minutes, we'll talk all about mutual funds, a couple of burning issues. We are in the midst of election season, and this is why we are calling this show Investing Amidst Elections. How should you approach your mutual fund investments, considering that we are entering a period of potentially extreme volatility? And with us to talk about that, a very special guest, Nilesh, Shah, Managing Director at Kotak AMC. Nilesh, so good having you. Thanks so much for taking the time out, and thanks so much for agreeing to talk on this very important topic. But before we get to the topic, Nilesh, is something that we do almost on every single show is talk about, before the main theme of the show, we address the burning question of every week. And this week's burning question is coincidentally a statement put out by Kotak AMC in a statement released earlier, wherein Kotak AMC has told investors in 2 of the fixed maturity plans that they may not receive the entire amount on redemption right now. The exposure to SL Group, I reckon, is to blame. Nilesh, the question on the minds of almost everybody when it comes to investments in such products is that will retail investors get the amount that they would have otherwise gotten if such instances wouldn't have happened? That is arguably the big burning question of this week. How would you respond to that?
Definitely, Neeraj. We had launched FMP 127 about 3 years back. Of the money collected, we had invested some money in SL Group promoter companies. These companies had given us pledge of 1.5 times Z shares. On 25th of January, there was a selling of about 200 crore worth of shares of Z Entertainment by certain lenders. This resulted in prices dropping from about 400 rupees to 280 rupees. However, on the weighted average price, it was about 319. On 26th of Jan, there was a meeting of 44 lenders. 7,500 crore exposure there was from mutual fund. About 4,000 crore was from NBFCs, and about 2,000 crore was from various overseas lenders. The 44 lenders representing collectively 13,500 crore worth of exposure to SL Group promoters took a call that if 200 crore worth of loan against shares are sold and prices could come down by 33%, there is no way we will be able to sell 13,500 crore worth of exposure without adversely impacting prices and converting our notional loss into actual loss. On 26th of Jan 2019, 44 lenders collectively took a call that panic selling of Z Entertainment and SL Group company shares will not be good for us. We won't be able to recover all our dues from selling of shares. After we reached that agreement, we entered into negotiation with the promoters so that our dues can be recovered and our unit holders could be protected. Yesterday we had one FMP maturity, FMP 127. Today we have another FMP maturity. In yesterday's maturity, we have repaid all the exposures, all the investments which we had made other than in Z Entertainment, other than in SL Group promoting companies, which were backed by the shares of Z, to our investors. We have not retained anything on that, contrary to popular perception or some news which is being spread out. The money which has been invested into SL Group promoting companies, those monies have been retained. We will repay that money when we receive that money from the SL Group companies. Now, because we have provided an allowance of time to SL Group promoting companies, I needed to ensure that our unit holders are protected. We are better secured today than we were yesterday because we have obtained personal guarantee of the promoter. We are better rewarded than yesterday because we have taken some upside sharing if there is strategic stake sale in Z Entertainment. We believe instead of resorting to panic selling of shares, which would have resulted into much lower recovery than our dues, it is appropriate to give allowance of time to promoters and also secure ourselves with better security and higher interest rates. This will work well for our unit holders. Of course, unit holders haven't received all the payment of their FMP on maturity, but if the little bit of time, little bit of delay they can afford, they will get back. We are quite hopeful that they will recover all their dues.
Nilesh, so just a couple of questions. I believe there is, two sides or two ways in which you can look at this story, glass half full or glass half empty. The glass half full argument first is that if at all lenders would have agreed to sell off the stake, which in normal course they would have, then the NAVs would have anyways taken a hit. So maybe you guys thought that let's give the promoters a chance to sell off the stake and then maybe get in the higher money. The question mark to that would be that what if, for whatever reason, the promoters of Zee Entertainment are not able to enter into the proposed stake sale within the time frame that has been agreed upon as of now? What happens in such a scenario? Because then if the standstill agreement doesn't hold, maybe the prices are lower, and then if the mutual fund or the lenders or you or some of your other peers go out and sell, then the hit will anyways be there and might be even larger than what was thought earlier. How do you address that possibility? And therefore, what happens to the investors of Kotak AMC or some of the other AMCs?
Nirav, these are all hypothetical questions. You will be asking me the question if I had sold the shares and you had seen what 200 crore selling had done to the prices. If 13,500 crore worth of sales would have happened, you could have very well imagined what will happen to the prices. And then you will be asking a question, who are these fund managers who have sold Zee shares at such a low price when they were buyer of these shares at 600 rupees just few months back? There is no answer to this. You have to look at what is good for your unit holders. We have been better secured, we have been better rewarded, and we are giving promoters time because it is in the interest of our unit holders. This is not working with promoters to help them. This is working for our unit holders because that will help us in recovering our dues.
Okay, just wondering, last couple of questions on this before we move on to the main topic of this show as well, Nilesh. One is, I'm presuming that the two entities that Kotak had exposure to, and I'm guessing a lot of other schemes have exposure to as well, they have defaulted, and as a result of which the monies that had to be redeemed to the FMP holders have not been paid in full, right? It's technically a default, and therefore, but because there is an agreement that the lenders have reached with the Zee promoters, that there is no redemption happening from the lenders' side.
Absolutely. There has been an allowance of time given to promoters so that they can make the payments within an extended period of time. Our FMPs are close-ended funds. They are not open-ended funds. Investors don't come in and go out. On the maturity of FMP, I have to make payment of the maturity proceeds. Of 100 rupee in the portfolio, let's assume if 90 rupees is invested into other assets which have matured and which are liquidated, and 10 rupees invested into SL Group promoting companies, I have repaid 90 rupees back to the investors. In total, we have 8 FMPs where Zee Group or SL Group companies are there in the portfolio, or ITNL is there in the portfolio. In 7 FMPs, we are returning more than the amount we had collected, along with some appreciation. It's only in one FMP which has matured today, where I am returning about 0.6% less. So every single investor in all those FMPs which have matured or which are likely to mature, based on our current estimate, we have repaid principal along with some capital appreciation, except in one FMP.
Okay. And final question, Nilesh, what would your message be largely to FMP investors? Because I think the debate that, or not really a debate, but a couple of topics that came about in conversations were that FMPs were considered to be such an alternative to fixed deposits per se, right? Yeah. But the idea should be that for anybody who's entered into FMPs, the idea should be not to maximize returns, but to optimize returns, and therefore enter into these plans with the knowledge that that is the purpose of this. If at all any question marks raised, what would your messaging be to people who have looked at FMPs in the past or even currently as options and might be thinking that what could be the near-term or the medium-term future be if indeed an event of this nature has occurred? it's probably for the first time after 2008 that something like this has happened again.
So in the fixed maturity plan, if you notice, there has been a deferment of payment. It is not default of payment. There are lots of articles which are being talking as if we haven't paid back to any of the FMP holders and they are unlikely to receive any money whatsoever from the FMP. I'm sorry, this is not Madhopura Mercantile Cooperative Bank, this is not Kapol Cooperative Bank, but deposit holders haven't received any money. This is FMP where we have repaid all the proceeds to the investors other than our investments in SL Group promoting companies and ITNL. In 8 FMPs where these two exposures are there, in 7 FMPs you are getting back your principal along with appreciation. Only in 1 FMP you are getting little less, 0.6% less than your principal. And as we work with the promoters of SL Group, where we have taken personal guarantee of promoters, where we have upside sharing if there is strategic sale in Z, combination of this will ensure that you will get back your money by 30th September along with accrued interest and appreciation. So you have to bear with the FMP investment. What we have done is that we haven't converted a notional loss into actual loss. Otherwise, all of you will be accusing us, why are we selling shares so cheap? We are not working for unit holders, we are working for the buyers of the shares. We are not doing that thing, we are protecting our unit holders' interest. And in order to protect my unit holders' interest, I have to work with promoters. If promoters are desperate sellers, they will not realize full value of their assets. If we give them time, and there are newspaper reports to say that they have put their stakes in various companies on block, and we are quite hopeful that they will be able to sell their assets in a reasonable fashion, in an orderly fashion. Their net worth, their assets are far more than the total borrowing they have done, and they will be in a position to repay lenders. This is not a question where there are only liabilities and no assets. It's a question of liquidity mismatch.
Okay, Nilesh, thanks so much for addressing those big talking point today. So important to take that as a burning question for the week. Now let's move on to the topic at hand.
Thank you for giving us an opportunity to explain our side of story.
Not at all. Appreciate you doing that. Let's talk about the big topic, Nilesh, and that is investing amidst elections. Now, a lot of people investing in mutual funds might wonder that, okay, there is volatility. Maybe volatility a month before, a month during the election season, maybe a couple of months later. Should I sit out of mutual funds right now for the time being? Because I lose out on 4 months. It doesn't matter. I'll come back after 2 or 3 or 4 months and then resume my investing if I have to. Or if the period still looks volatile, then maybe I'll just take a bit of a break. Is that a correct approach, or people should actually make use of volatile times, and especially during elections as well?
If you are taking time out of the market, it is like playing on a cricket pitch looking at the wicket keeper rather than the bowler. Experience has taught us that it is time in the market which makes money for you rather than timing the market. If you look at the market itself, if in 2013 you would have taken a call that there will be a stable government post-election, you could have invested around 18,000, 19,000 Sensex. And today at 38,000, that's a reasonable return. But if you had waited for election results to come out in May 2014 and then invested, you would have probably entered at 28,000 Sensex. And then 28 to 38 is good, but it is not as good as 18 to 38. Market has to be invested in given time rather than trying to time after all the uncertainty. There is no free lunch in any market. Because you take the risk of uncertainty, your reward will be higher. If you don't take the risk of uncertainty, your reward will be lesser. So my recommendation to investors will be, please don't look at the events. There will be many more events which will keep on happening in the market. What you have to look at is your asset allocation and your investment objective. If you are investing for retirement in 2030, 2035, 2040, will 2019 election make a difference? Answer is no. What will make a difference is how much you invested as a percentage of your wealth in risk assets like equity, real estate, and how long you gave time to those investments.
Okay. Nilesh, there will arguably be some volatile times, though, I mean, one can even argue that if one thought that the run-up to the elections would be volatile, as of now, we are a stone's throw away from all-time highs. So actually, it's been volatile, but with a positive bias. But my question to you largely is that if we look at past performances too, in the run-up to the elections, the period post the elections, large cap schemes, small cap schemes, thematic schemes, all of them have tended to give positive returns. That therefore, this whole myth of what happens in the election result could have a big bearing on returns from the markets and therefore the funds is also a fallacy, right? I mean, what happens on May 23rd, will that have a big bearing on what the long-term returns for an average mutual fund investor would have?
Neeraj, you made a brilliant point. Election results are very, very critical on the result day. In 2004 election cycle, we had seen that markets had corrected almost 15% on the result day because it got a surprise or a shock from the election results. In 2009, markets were up 20% because it got a surprise from election result. But clearly what happened after election, which makes material impact on investors' return, was exactly opposite of what happened on the result day. In 2004, on the result day, markets were down about 15%, but thereafter we saw the biggest rally of our life, where if I remember correctly, Sensex moved from 4,500 to 21,000 by Jan 2008. In 2009, investors were richer by 20% on the day of election results, but post that, it was a very subdued market where index barely moved from 15,000 to 18,000. So election results matter on the result day. If market has priced in a certain kind of government and there is a surprise or a shock to that, there will be material movement in the market. But thereafter, for next 5 years, what is the shape of the economy? What is the work done by the government? What is the corporate profitability? Those kind of fundamentals will determine investors' return. So we have to look at what is in our control, which is the fundamentals of economy, rather than election kind of event.
No, the other question to this, and particularly specific to this election period, Nilesh, would be, you're going to argue that all elections are close, but this one seems very close. That is one. Two, we are sitting at new highs, and we are sitting at valuations which are high. Now, you could argue that PE may not be the right way to look at it for the Sensex because the earnings have not been trending and therefore look at price to book or otherwise. But working with a simple assumption that if we look at a price earnings multiple of what the index is right now, it is expensive. Would it be prudent for a mutual fund investor to try and time the markets this time around simply because we are at highs, there is volatility, and there is no clarity on what the global scenario is looking right now? So should one ponder over that at all, or you wouldn't do that also?
I will always go by asset allocation principle. I have the humility to accept that there is no way I can time the market. I haven't met a person who can predict tomorrow. If you are overweight equity, certainly this is the time where you should book your profit. If you are underweight equity, despite higher valuation, you should invest into equity market to become neutral level. If you are neutral weight to equity to your investment objective and risk profile, this is the time to maintain neutral weight and continue doing your systematic investment plan. It is not the valuation of market which determines what you should do. It is also, along with valuation of the market, your own risk profile and investment objective and asset allocation which determines what you should do. So if you believe market is overvalued and you are overweight, please take your profit. But if you believe market is fairly valued and you are underinvested in equity, then please continue investment via systematic transfer plan or via systematic investment plan.
Interesting. Nilesh, we did some data crunching of what some of the thematic funds or other funds have done in past elections. In 2009, which is March to May 2009, before and after, so banking funds, for example, or even banking funds in March 2014 to May 2014 and post that. Yes, the quantum of returns may vary, but the returns have been positive nevertheless. Past returns may not be a guarantee of what the future could do, but are they indicative of what the markets can do? Is that investors may get perturbed, but smartly invested monies, using volatility as a tool rather than anything else, might actually lead to better returns from mutual fund investing?
So essentially, if we see the market, it is at a slight crossroad. There has been some amount of economy which is showing subduedness. The auto sales in the month of Feb and March has been disappointment. The white goods sales also has been disappointment. Investments is picking up, but at a much gradual rate. Somewhere this softness of the economy, this below potential growth rate, it is not a negative growth rate, it is still a positive growth rate, but it is below potential growth rate, is kind of being ignored by the market. Now there could be a couple of reasons why market is ignoring this. One, market has priced that the government will be fiscally prudent. Your better macroeconomic fundamentals indirectly result into higher valuation. Second, market is also expecting real interest rates to come down. For last couple of years, RBI managed to bring down double-digit inflation to lower single-digit, and this was achieved with tight liquidity and high real interest rates. But as inflation has come down, it will also bring inflationary expectation down, and this will leave RBI to bring down real interest rates in a significant manner. Bringing down of real interest rates will be beneficial for corporate profitability. Third, we have also seen tight liquidity, especially after September 2018, where due to FX interventions and increase in currency in circulation, banking liquidity has been restricted, constrained, and this has an indirect impact on credit. Without credit, investments can't happen. Without credit, working capital can't be financed. So there is some impact on growth because of limited liquidity. Generally, currency in circulation starts decreasing after election, and we hope that RBI's innovative solution like FX swap, along with currency in circulation coming back post-election, will provide necessary liquidity for economy to provide credit and grow. The third thing is related to transmission of credit. Especially after ILFS default, there has been pressure on transmission of credit, and this has also deprived certain critical parts of economy from expanding at a faster pace. Real estate, infrastructure, small and medium enterprises, all these sectors are today working with a limited credit rather than abundant credit. So market somewhere is pricing in that going forward, fiscal prudence will be maintained, real interest rates will get normalized and come down, liquidity will improve, transmission of credit will improve. Combination of this will result into better earnings growth in the days to come, better economic growth, and hence market is ignoring little bit of subduedness, little bit of below potential growth rate in the economy right now. The other thing which market might be considering, that optically some of the earnings will look far better in FY20 over FY18 or FY19. Corporate focused private banks, in absence of making large provisions for NPS, will collectively show much higher profits in FY20 over FY18 and FY19. Pharma companies with generic presence in US markets will also be able to show better profit in FY20 over FY18 and FY19. Some of the conglomerates having global presence, which have recorded one-time losses in FY19, will not repeat that losses in FY20, and hence then number will also look good. So optically there might be better earnings growth in FY20 led by corporate focused banks, both private and public, generic focused pharma companies and conglomerates, and this also will support the market.
Well, you pretty much answered almost everything that I would have wanted to ask you. Understand we have to let you go, but just one final question, Nilesh, and that is, would you believe that the underperformance of the broader end of the spectrum, wherein retail investors either via direct participation or in this case via multi-cap funds, small cap funds and mid-cap funds have also been large participants, will that underperformance correct itself, not necessarily in the next 6 months, but over the course of the next 1.5 years? You believe broader market companies can show the profit growth and thereby price performance?
For broader market to outperform, Neeraj, the economy has to pick up the momentum to reach to its potential growth rate. We believe if we have built the platform or foundation in last couple of years to go to that higher potential growth rate. Our tax compliance has improved reasonably well compared to past. From about 10% tax to GDP growth in 2010, gradually it has improved to about 12%, is expected to improve to 12% in FY20. Second, we have reduced complexities of doing business by jumping up in ease of doing business. Third, infrastructure has been built. Fourth, our rupee is now fairly valued and hence Chinese dumping or our large trade deficit with China will be controlled. On top of it, we have built a solid macro foundation with lower inflation, which allows us to now pump liquidity, cut interest rates, and if we can do better transmission, combination of all this factor will result into economy reaching to its potential growth rate, and that will be beneficial to corporate earnings growth, and that will allow broader market to catch up with few better performing stocks in the large cap indices.
Okay, Nilesh, appreciate you taking the time out and giving us some pearls of wisdom about what to do amidst the election times and volatile times. Keep calm and stay the course. I believe that's the messaging that should come in. Thanks so much for taking the time out and being with us today on the Mutual Fund Show.
Thank you.
Right, that's Nilesh Shah of Kotak Mahindra AMC with his thoughts on mutual funds and what should you do in a scenario like this wherein we are getting underway on the election season. With that, it's a wrap on this edition of the Mutual Fund Show. Thanks so much for watching.